In the short run, markets are pretty volatile, and day to day, it's hard to know what moves them. We like to look for the longer term, and the longer term we think is very positive for markets and for economic growth, largely on the riding the crest of tax and regulatory reform that we've seen over the last year and a half. So we're pretty upbeat, even though a day like this could give you some pause.
So you're not worried about escalating trade tensions and tariffs, which are new rounds set to kick in against China first week of July?
Well, certainly things would be better without those tensions, but even with them, we don't think that they're enough to derail the very positive momentum we have from those other policy forces. Three of the four major policy drivers are either benign or positive. There's fiscal and monetary policy, along with regulatory policy, have been supportive of growth. Trade policy is the one negative right now, and we think largely there's negotiating tactics going on. We don't know what the ultimate outcome will be, but long run, we still think growth dominates, which is very good for our business.
Are you buying? Are your clients taking this opportunity and buying these dips?
We are buying when we have positive cash flow, which most of our clients do. We have to be invested against their obligations. Most of our clients at Conning are constrained optimizations like pension schemes and insurance companies and LDI and things like that. So we always want to be invested against those liabilities so that they're supported. But we really would like to see good assets to buy, and we think as rates rise along with growth, we'll be able to buy risk at a better price. So yes, we're buying for the long run.
How are you filtering trade into your thinking?
As I said, trade is the one negative on the policy front, but again, don't think it derails the overall, the long run picture. From a sector standpoint, though, that's something to think about. Certain sectors will be differentially damaged by adverse trade conditions, like, say, agriculture. That's one of the sectors that certainly could be hit pretty hard. Retail, apparel sells, most apparel is manufactured offshore. Bringing that in, it'd be expensive for those kinds of businesses.
So what are you buying? So which sectors are safe?
Well, what we like are sectors that have been that have weathered through some parts of the credit cycle. We are primarily fixed income buyers, and two sectors that have had some of their problems washed out in the last couple of years are, say, energy and basic materials. We like those sectors, but we like opportunities in virtually all sectors across the board. And it's a matter of fundamental analysis to pick out the right issuers and the right bonds to buy.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.